Something happened in the American financial system this week that almost nobody covered. For 11 straight weeks, the biggest pools of institutional money in America walked away from XRP. 11 weeks, 77 days of silence. And then between April 12th and April 15th, those same institutions put $38.86 million back in. On Wednesday alone, $17.11 million hit these funds in a single session, largest single day since the 3rd of February. The price is not at a bottom. XRP is near $1.40. It is up 6% on the week. So nobody is buying a discount. Somebody is positioning for something. Today, I will show you 3 things that landed between April 13th and April 15th that explain this. I will show you the receipts, and then I will show you the 3 walls still standing between this token and $2. So let us break it all down. The bet itself. April 14th, $11.2 million in. April 15th, 17.11 million more. Second strongest 2-day run these products have had since launch in November. Total assets across all 7 funds just crossed $1.25 billion. The leaders inside that flow are not random. Bitwise pulled in $6.23 million in one session, 21 shares pulled in $5.43 million and broke a dry spell over 2 months long. Franklin Templeton, a firm that manages roughly $1.6 trillion across all its funds, pulled in $5.3 million. These are not retail wallets. Somebody at each of those firms signed off on buying XRP this week who had chosen not to for 11 weeks straight. On top of that, MassMutual, the life insurance company, reportedly added Bitwise XRP exposure to their holdings. When a life insurance giant shows up inside these flows, that is not a trade. That is a multi-decade balance sheet taking a position. So what changed? 3 things, in order. Thing number 1 is the quietest and the biggest. On April 13th, the staff at the trading division inside the Securities and Exchange Commission issued a written statement. A boring title. Most people scrolled past it. Here's what it actually says in plain English. If you build an app that lets a user trade crypto from their own wallet, and you do not hold their money, you do not route their orders, you do not give them advice, and you charge a flat fee, you do not have to register as a Wall Street broker, that is the whole thing. Why does that matter for XRP specifically? Because of something most people do not know about this token. The XRP Ledger has a decentralized exchange built directly into the protocol. Order books, automated market makers, cross-currency routing, all native, all since 2012. Think of it like plumbing. On every other blockchain, if you want to build a trading app, you have to install the pipes yourself, weld the joints, test for leaks. On the XRP Ledger, the pipes are already in the walls of the house, have been for 14 years. Here is where it gets uncomfortable. And the data does not lie. Under the new SEC staff statement, American developers can now build trading interfaces on top of the XRP Ledger without registering as brokers. The entire American DeFi industry on every other chain has been tied up in legal knots for 4 years. XRPL just got handed a cleaner path because of code that was written in 2012. This is not a Ripple win from 2026. This is a 14-year-old architectural decision that just became a regulatory advantage retroactively. No smart contract chain can copy this without rebuilding their core protocol. The statement sunsets in 5 years unless the full commission takes further action. But for 5 years, the door is open. Thing number 2, April 14th. Ripple announced a pilot with Kyobo Life Insurance in South Korea. Kyobo is one of the largest insurance companies in that country. They are piloting the XRP Ledger to settle tokenized Korean government bonds. Government bonds. The most boring, most heavily regulated asset class on Earth. Moving on to XRPL. Thing number 3, April 15th. Rakuten, the largest online retailer in Japan, turned on XRP payments. 44 million users, 5 million merchant locations, loyalty points convertible directly into the token. Standard Chartered called this a third catalyst their original model did not account for. Their old thesis had two drivers: exchange-traded fund inflows and regulatory clarity. Rakuten adds a third one: real consumer payment volume. All right, that is the data. Now let me tell you what is fighting against it, okay? Bullish case made. Now let me stress test it. If all three of those things are real and institutions put 38 million back in, why is XRP still at $1.40? Here is the sell pressure nobody wants to talk about. According to on-chain data from Glassnode, roughly 36.8 billion XRP coins, about 60% of every XRP coin in circulation, were bought at an average cost basis of $1.44. 6 out of every 10 XRP coins that exist are owned by somebody currently underwater, waiting for one thing: to break even and sell. Think of $1.45 as a wall. Behind that wall is a crowd of millions of wallets waiting to exit. The moment the price touches the wall, the crowd comes through. We saw this in March. On March 17th, the SEC and the Commodity Futures Trading Commission jointly classified XRP as a digital commodity, biggest regulatory win in 5 years. XRP spiked to $1.60. Within days, right back below 145, because every person underwater sold into it. Standard Chartered cut their 2026 XRP target from $8 to $2.80 back in February, 65% reduction. The largest near-term cut they have made to any crypto forecast. They raised their 2028 target in the same report to $12.60. The long-term thesis is intact. The near term, which is what your portfolio feels right now, they think is capped, and the prediction market Polymarket is pricing a contract asking whether XRP will close above $1.80 by April 19th, 2 days from now. The market is pricing that outcome at 0.2%. 0.2%. The crowd has decided the rally stops here. Fundamentals set the destination. Macro sets the timing. Now here is why none of this has translated into price yet. The Federal Reserve is holding benchmark rate locked between 3.5% and 3.75%. Has not moved since January. Next meeting April 28th and 29th, 11 days from now. Think of Fed rates as gravity. When rates are high, gravity is heavy, and risk assets like XRP cannot escape the ground. When rates come down, gravity weakens and speculative assets can climb. Right now, gravity is heavy and not changing. And something is making the Fed's hand harder. Oil. Brent crude near $100 a barrel. The ceasefire between the United States and Iran expires April 22nd, 5 trading days from now. If that ceasefire breaks, oil goes higher. If oil goes higher, inflation goes higher. If inflation goes higher, the Fed cannot cut. Every investor in this token right now is not really holding a bet on Ripple. They are holding a bet on the price of a barrel of oil between now and the end of April. Jerome Powell's term as Fed chair expires May 15th, 28 days away. Markets hate leadership uncertainty. Until a new chair is named and signals their stance, the big desks stay defensive. Here is the part where I might lose some of you, but I would rather lose viewers than mislead them. One uncomfortable data point. Standard Chartered pointed out that XRP's assets under management across all these funds represent only 1.2% of XRP's total market cap. Bitcoin's exchange-traded funds hold about 6.4% of Bitcoin's market cap. Despite the 11-week streak breaking this week, institutional money is still dramatically underexposed to XRP compared to Bitcoin. Read it as weakness or read it as runway. If XRP funds ever caught up to Bitcoin's percentage, it would imply roughly 4 times the current inflows. Every one of these levels has a story and a price tag. First wall, $1.45. Cost basis for 60% of every holder. Not just a resistance level, a wall with a crowd behind it. To break it, XRP needs to reach that price with enough buying pressure to absorb 36 billion coins trying to exit at the same time. The test that matters is whether XRP can hold above $1.40 for 3 consecutive daily closes. Second wall, $1.55. The 100-day exponential moving average, a long-term technical line institutional desks watch closely. Breaking this means this is no longer a bounce, it is a trend. Third wall, $1.60, where XRP topped in March after the digital commodity classification. The high from the biggest regulatory win this token has had in 5 years. If the market could not hold that level on that news, breaking it now requires either the full Clarity Act passing the Senate or a Fed shift. Possible, not guaranteed before end of May. 4 signals to watch. Signal 1. Next week's ETF flows. This 4-day streak was $38.86 million. Watch whether the funds can post another positive week, ideally above $50 million, in the 5 trading days ending April 24th. If they do, the institutional re-entry is real. If flows flatten, the silence was interrupted, not ended. Signal 2. The Senate Banking Committee Clarity Act markup. Committee targeting late April. A clean markup before April 30th is the first step toward Garlinghouse's end of May target. A delay past April 30th pushes final passage into summer. Signal 3. The April 22nd Iran ceasefire. Watch oil. If Brent stays below 100 and the ceasefire holds, risk assets get a green light. If it breaks and oil goes above 110, the Fed is pinned and XRP goes nowhere. Signal 4. The Fed meeting April 28th and 29th. Nobody expects a cut. What matters is the language. If Chair Powell signals cuts are possible in June or July, risk assets move before the actual cut. If the language stays defensive, XRP stays pinned. You do not need to guess, you just need to watch these signals. Institutions broke an 11-week silence this week. The reasons are real and structural, not hype. But the price is pinned under a wall of 60% of holders and a Fed that cannot cut while oil is at $100. Tomorrow we find out whether Thursday's inflows held or reversed on Friday. One session will tell us if this was a 4-day blip or the start of something bigger. I will have the number the moment it lands. Fundamentals set the destination. Macro sets the timing. Stay sharp. Stay informed. This content is for informational and educational purposes only. It is not financial advice.